Chapter 14, Managerial Accounting Concepts and Principles. What is the purpose? Before we define the purpose, who can tell me what is managerial accounting? And let me preface it with this. Managerial accounting is a distinct specialty within the accounting trade. Just like in week one, we looked at different forms of accounting studies. We looked at it from a CPA's perspective or a practitioner. We looked at it from the financial accounting side. I commented that there was managerial accounting. So what is managerial accounting?
An activity that provides financial and non-financial information to an organization's managers.
Provides financial and non-financial information to an organization's managers for the purpose of
provide useful information to managers.
To provide useful information to managers for the purpose of
Determine the cost of products and services.
Let's back up. We're getting warmer now. Let's go back. Why do managers need to know important financial and non-financial information?
To do their jobs.
To do their jobs, to make decisions. These reports or this accounting is going to give them useful information about the company in order that they can make important decisions affecting the company, both involving short-term and long-term goals. So let's look for planning, for monitoring, long-term strategic plans, and for control. Planning are going to involve those long-term strategic plans, strategic aims, annual budgets. Control, go back to our opening example of monitoring activity inside your bank accounts and reconciling books, how internal procedures, internal controls, the usefulness of these measures. Managerial accounting, monitoring. How can we monitor the activities within the institution? All right, now your text is going to give you a slide called The Nature of Managerial Accounting. I'm not going to walk you through each of those, but be sure you reference. All right, let's talk about this control and monitoring piece. Why is it important for managers to have control and to monitor the accounting activities within the organization? What is something that we might want to prevent? Theft. Let's back it up and just say fraud. Illegal. We won't even say illegal right now. We're just going to say fraud and theft. All right, fraud affects all businesses and it is costly. Your text tells you that a 2014 report to Nation from the Association of Certified and Fraud Examiners estimates that U.S. businesses lose 5% of their annual revenue due to fraud. I will say the Institute of Accounting Management has a code of ethics that is going to help accountants adhere to and follow if you do find yourself in the role of a managerial accountant. Okay, so what is, 5%? Lindsay, what were you saying makes good puppy pads?
Chucks.
Chucks.
Which are like human puppy pads for patients that are like in ICUs and stuff, just so they have accidents, they don't ruin the sheets, you can pull them and then
human puppy pads.
Pretty much.
All right, so removing those from the work, that's going into that 5% of lost revenue.
I didn't say I did.
And I heard an example earlier of paper clips.
But I always advertise.
But they advertise, but they say. All right, so just when you think about what I'm saying, yes, we can go to the extreme measure and say actually fraud or theft, the attempt to deceive and remove, but sometimes small items get overlooked. And if enough small items do accumulate, especially within larger organizations, it doesn't take long for small numbers to compound up and equal big numbers. All right, cost classifications. Cost behavior refers to how a cost will react in changes in the level of business. All right, so let's illustrate. How's that marker? All right, so if we want to call this cost and we want to call this activity. When I refer to fixed cost, what am I referring to? So who can tell me fixed cost? And if I were going to draw fixed cost up on this graph, how might I draw?
Straight line.
Straight line. So fixed cost.
Because no
I
matter,
will abbreviate by FC for now. Do not change when activity changes. So here, as activity is increasing, cost remains constant. If we drew costs like this, what are we referring to? Variable cost. We'll call that AC. So here we're going to see that as activity increases, cost is also going to increase. Give me an example of direct cost or fixed cost.
well, our book says rent for the factory used to produce bikes.
Rent. As I say in this classroom, we have, I mean, we have absent tonight. Three folks are absent.
Four.
Well, she dropped.
Oh, she
Okay,
dropped.
so three are absent. Did the landlord lower rent for the university?
No.
No. So rent is going to be a fixed cost. Variable cost. Give me an example.
Materials,
Material.
like,
Like,
black cost, the book, bike tires.
Bike tires,
like,
if you're a bicycle, if you're the Schwinn or the Huffy manufacturer, Mongoose, you're buying tires to put on the bike for sale. As you buy more tires or as you sell more bikes, you're going to have to acquire more tires, and therefore your cost of tires will increase. All right, now what about cost as a form of traceability? We can also say that costs are either direct cost or indirect cost. And who can give me an example? Who can first define a direct cost and then give me an example of it?
Direct costs are traceable to a single cost object. And our book uses tires, seats, so basically materials for the bicycles.
So trace to one object. And indirect
cannot be easily and cost beneficially traced.
cannot be traced to one object. Give me an example of a direct cost.
Indirect salaries.
Indirect salaries. Give me an example. Who's going to draw an indirect salary?
Supervisors.
Supervisors. Individuals who have oversight of more than one department. Okay, so let's think of your C-level suite. the CEO of the firm who's charged with management of the day-to-day, complete day-to-day operations of the firm. They're responsible for all of the operations, not just one single department. Within that one single department, especially not within one single product. Direct. Example of direct. Indirect, no, direct. We say it can be traced back to one object. What would be an example?
Like what we were talking about in the book is talking about the tires would be a direct cost. Seats, brakes.
And also think about labor. If that labor is only charged with, if you've got one person whose sole purpose is to, and their only purpose is to install those tires when they came in. All right, let's look at period and product cost. Book's going to give you an example starting in 2015. We see year 2015 cost incurred. Who can walk me through this chart? Period cost. When are those costs incurred? We're going to transition from 2015 cost incurred all the way out to a 2016 income statement. God bless you.
Thank you.
So in 2015, period cost, where are those going to flow to? The income statement for 2015. So here we're going to assume that these costs, we went out and acquired these costs in 2015. They're going to be reflected on the 2015 income statement. Now the inventory is not sold until 2016. Where is that going to flow out?
Balance sheet.
The 2016 income statement?
The 2016 income statement. Okay, now you heard balance sheet. If you were preparing a balance sheet during those years, and we're focusing on right now cost associations. So when we think of cost, remember back to my opening example, where are we going to see those costs? Right under sales revenue. Those costs are going to be part of cost of goods sold. If those are direct costs, those would be cost of goods sold. Sales minus cost of goods sold gives me
Margin.
gross margin. All right. Advertising. Is it fixed or variable?
Variable.
Well, think if I were going to do advertising for my firm, I'd probably go to someone and say, here's my advertising budget. I want to advertise via online and
So you just be paying basically for like the space for advertising, like you do
Like
it
a
online, it'd be
radio
like an ad, yeah. And it'd
yeah,
just be
so
a
I would
set.
go to someone and say, here's what I'm willing, here's what my budget will allow me to spend on advertising.
So wouldn't that be fixed?
It would be fixed. I know what it's going to be. So we said bicycle tires and wheels were variable. I said wages on an assembly worker, that assembly worker working directly on bicycle assembly would be variable. Advertising we'll call fixed. Would advertising be direct or indirect?
Indirect.
Indirect. All right, production manager salary, we covered that. Office depreciation. I hear fixed. Why is it fixed? Come on. I see you there. Come on. You smiling. You know it. Take that mic off mute.
I promise you I don't.
So depreciation, you said is, okay,
Is it, well, it would be like considered like a period cost because it's associated to like a time period than an actual,
It is, but right now we're looking, is it fixed
well, that's,
or variable? And we've said fixed, so why is it fixed?
depreciation, because depreciation goes.
Because we have a fixed depreciation schedule that we're going to apply.
Like the years. and
Accounting
the-
standards are going to give us a depreciation
well, that's
schedule.
what I was trying to say in a roundabout way. Sorry.
Yeah, I just kept thinking like, because that math problem you gave us like 2 weeks ago, that one,
That one.
that one, that's why.
Direct or indirect?
That would be indirect.
Indirect. Product or period?
Period.
Period. It's going to follow a time schedule. All right, cost concepts for service companies. So these examples that we're going to refer to now are going to be most commonly found within service-based companies. All right, so let's look at beverages for passengers of Southwest Airlines, variable or fixed?
Variables?
Variable. I hear variable, I hear fixed.
I see fixed.
Who said fixed?
I did.
2 fixed, 1 variable.
Like, I know that the
Hold
prices.
on. So we got two fixed, 1 variable, and 2 non-spoken. You unspoken, let's cast a vote. 2 variable, 2 fixed.
I would say variable. Can I give a reason why?
Okay, 3 variable, 2
Yeah,
fixed.
that's what I'm.
Well, let's first hear from the fixed people. Why fixed?
Like the price
Or
of
the
the,
yeah.
yeah. But then with,
I feel like it's a set rate probably already.
Excuse me?
I said I just feel like it's a set rate for beverages.
It could be a set rate, but
if you're buying $100, but you only sell 2 of them, or it's
well, let's
$100
apply
each
this
time.
to drinks sold on
Well,
an
I
airline.
would say, but count on like the number of
the
flights.
people and like the flights that you have.
number
with-
of-
Even if
Even
if my purchase, let's just say is 50 cents a drink, but if I have 100 passengers or I have 150, I don't think I can go through there and discriminate and say, you don't get a drink. You're only going to get a drink. You can't get a drink.
Yeah.
So it's going to be a variable.
Okay.
As more passengers come onto that plane, my costs are going to increase.
Why is it?
At a restaurant, all the food's the same on the menu, but you're gonna make.
What'd you
more-
say?
I see. I just wonder why is it variable. I didn't understand.
Because as the number of passengers increases,
Mhm.
your costs are going to also increase.
I hope that's not raining. My window's open.
That's air.
Oh my God, okay. I was like, oh no.
Now, if it's raining outside, I can't speak to that, but what just kicked on was
Okay,
the
good.
air.
So like, it's, like at a restaurant, it's kind of the same concept. Like their menu prices are set, but they're gonna make more money depending on how many people show up. But they're gonna need more like servers and stuff too, to compensate for these extra people coming in, correct? Do I kind of maybe have a kind of somewhat?
If that labor, yes, just always think about, as your activity increases, if the cost associated also increases, that is a variable cost.
Okay.
If cost remains constant regardless of output, it's fixed. Now, if that cost can be directly linked to one, or when I say linked, traceable to one object, it's direct. If that cost is spread across an entire organization, or let's just say more than one, we're going to call it indirect. All right, let's look at some manufacturer cost. What are some costs? Direct material. And I'm getting these numbers from your book. Factory overhead. And direct labor. Direct materials, 45%. Direct labor, 15%. And that would make that 40%. Direct material cost represent 45% of the average manufacturer's cost. Direct material costs are the expenditures for direct materials that are separately and readily traceable through the manufacturing process of final goods. So these are expenditures for direct materials that can be separately traced through the manufacturing to finished goods. So the direct materials that are traceable all the way out to finished goods. Again, an example of a direct material would be, let's just keep it on this bike example. We've used tires. So the steel frame. Direct labor.
Wages,
Wages to who?
employees,
Let's be more specific.
Like linemen? Wages?
yeah, I was just say assembly workers. I said-
Assembly workers. Factory overhead. And by the process of elimination, I would tell you that factory overhead is everything that is not direct materials or direct labor.
Like advertising, rent, those types of things.
Advertising. Maintenance. If we want to link direct materials and direct labor, the book is going to tell you that we have something called a prime cost. And a prime cost is going to be direct materials and direct labor. Conversion cost is what?
Expenditures incurred in the process of converting raw materials to finished goods.
All right, so conversion costs are going to involve your direct labor. We're going to have an overlap of direct labor. Prime cost we'll define as what?
Sorry, can you get that question again?
Prime cost. Define it.
Expenditures directly associated with the manufacturing of finished goods.
Directly associated with the manufacturing of finished goods.
Direct materials plus.
All right, and those are going to include direct materials and direct labor. Think about this. What are we needing for manufacturing?
Materials and people.
Materials and people. Now, once we have it manufactured, what must we do? We must move it out the door and get it sold. We must collect that revenue. Okay, that can also include direct labor and factory overhead. So again, think of everything from the collections department, billing, sales folks. We define up here advertising, maintenance. All right. All right, let's start looking at some financial statements. First, the balance sheet. All right, we're going to break this down from merchandisers to manufacturers. Merchandisers do what? They buy finished goods. So we're recapping now. So we're going to say that merchandisers buy finished goods. Now what do they do with those finished goods?
Sell.
They resell.
They sell finished goods. The manufacturers, what do they buy?
Materials.
Buy raw materials. And what do they sell?
Finished goods.
But before they sell, they must take these raw materials and produce. After they produce, they might sell finished goods. Who's going to buy those finished goods?
Merchandisers.
The merchandisers. All right, what accounts are we going to have affected here on the balance sheet?
Okay.
So let's start with the manufacturer, or excuse me, start with the merchandiser.
Assets.
Assets. Specifically,
Cash.
cash. Give me another one.
Accounts receivable.
Accounts receivable. So we're going to say current assets. Merchandise. What about the manufacturer? What assets are going to be affected? So they buy raw materials. What are they going to use to buy?
Cash.
Cash. Those raw materials. Might call inventory. Okay, so again, you see the difference. All right, let's look at
What is it? After something inventory,
cash.
cash inventory.
Cash and inventory. So we're going to see that inventory is going to be the key difference between these two types of organizations when it comes to what's affecting their balance sheets. All right, raw materials. Think about raw materials as materials that are waiting to be processed. These materials can be direct or indirect. So raw materials, items that are waiting to be processed, can be direct or indirect. All right, after we acquire the raw materials, what's the next phase? We're over here on the manufacturer right now. We must then start processing those goods. So we'll call those goods in process. We acquire the raw materials, we've got to start processing those raw materials. This is going to include all of our partially completed products. All right. Now, what are some of the costs we're going to have involved here? What's some more costs that we're introducing here?
Labor?
Labor. Okay, and probably some overhead. You could include some overhead, but you're definitely going to have labor. The final piece, after we have the goods in progress, next,
Transportation?
well, finished goods.
Oh.
So it's going to start with raw materials, go to goods in process, then we're going to go to finished goods. Finished goods are going to include all of our completed products available for sale. Definitely going to include both direct and indirect. Definitely going to include overhead. All right, so here's what we looked at. Call that the balance sheet. Now let's look at the income statement. So a merchandiser, we said buys finished goods. Okay, so they are going to have, when they buy this finished goods, they're going to put this in their inventory. So we're going to look at, I'm going to abbreviate inventory with INV, but you're going to have beginning inventory. From that inventory, what must you add? I want to change that up for a second. We're going to call it cost of goods. So anything that we've added, cost of goods purchased. So what did we have to add, or did we have to add anything to get this available for sale? What are we going to subtract?
Whatever's left at the inventory.
Well, you can subtract your ending inventory, and that's going to show you cost of goods sold. Now, under a manufacturer, again, we're going to start with beginning inventory. We're going to add in cost of goods manufactured. They then are going to back out their ending inventory. And what's this going to give? I'll move this over here. Cost of goods sold.
Down. Oh.
Thank you.
All right, now the last statement to look at the impact of. All right, a schedule of cost of goods manufactured. So flip over into your text until you get there. What is a cost of goods manufactured?
What is the cost of goods, or what is the schedule of cost of goods?
The schedule of cost of goods manufactured.
It says it contains information useful to external users, but it is not a general purpose financial statement.
It's not a general purpose financial statement. However, it is useful. Who's it benefit? We'll say benefits decision makers within managerial accounting, but it's going to affect the decision makers. It's an internal report. And what are some materials? The schedule of cost of goods manufactured summarizes the types and amounts of cost incurred in a company's manufacturing process. So summarizes the types and amounts of cost incurred in a company's manufacturing process. Go back to the prior slide. What were some of the costs incurred in our manufacturing process?
The raw materials.
Raw materials, labor, overhead.
The production.
Summarizes the types and amounts of cost incurred in manufacturing process. Or again, it's not an official statement, but we'll see why. What's the first item once we've acquired these items? Okay, what's going to be the first type that's going to show up on this schedule?
Direct material.
Direct materials. What direct materials did we use?
Raw materials, inventory.
What else is it going to include? Once we acquire these direct materials and we have these, we're costing for them. What must we use to put these direct labor?
So now we're going through the 4 steps of scheduling?
Right now, I'm just outlining the schedule. So we're going to add in direct labor. What else is incurred?
Factory overhead.
Sum these 3 items up and you have total manufacturing costs. And what was the next phase? Under the manufacturing, once they went through once they initiated the process, we then looked at working what? I'll learn to spell. Remember, goods in process. I'm gonna abbreviate. This goes all the way back to me being a student. And trust me, there's not been one person in my organization who's not asked me, what's WIP?
That's what I was going to say. You see what I was doing? Like,
What is
did
WIP?
that before?
And you learn real quick, WIP, work in process.
Okay.
Okay, I was about to say, please tell me what they're doing.
I was looking like, man, there's something wrong.
And again, we're in financial services, in accounting, we're labored with.
I thought it was W, like, OVP, and I was like,
All right, so WIP, work in process. See how quickly I can go back and add that. And what's this going to give me?
no, not what I was gonna say.
Schedule of cost of goods manufactured. That gives you the cost of goods manufactured. Now the book, I'll have you refer to a manufacturing statement shown in your textbook. And here we use direct materials. Okay, and we see examples included of raw materials. Direct labor, factory overhead, includes indirect labor, factory supervision, repairs, utilities, work on the building. All of those are examples of factory overhead. We want to add in our beginning work in process. Subtract out any ending work in process, and that's going to tell you what costs were incurred during the work in process. Add that to total manufacturing costs, and we have the total of cost of goods manufactured. Okay, let's wrap this up and make this applicable to. Listen up, feel free to elaborate on this both now in discussion as well as in your discussion boards. Trends in managerial accounting. So how can we use this stuff? Where do we find managerial accounting? Specifically, we defined it as reports, information given to decision makers for the purpose of decision making. It's internal reporting. So when we talk about managerial accounting, we're talking about internal reporting. Okay, but this is going to affect what must you have if you manufacture something and you get it ready for sale.
You need customers.
You need customers. So we find managerial accounting applying to customer orientations. How can we get the customer? Okay, think of right now, clothes that you're wearing, cars that you drove, items that you use today. Probably a pretty good assumption here that a lot of those items were manufactured outside the United States. Okay, now thanks to the internet, we can acquire goods and sell those goods all across the globe. So we do have a global view here. In order to process those payments through the internet, we have e-commerce. Now, even within service-based entities, those service-based economies, we find these same items. So just don't think they apply to the manufacturing side. Now, let's really automate this up. Who's ever heard of just-in-time manufacturing? Who's ever heard of lean management, lean accounting? Okay, here, just-in-time means, hey, I like to think the Japanese economy for introducing us to this. I like to specifically thank Toyota Manufacturing for implementing this years ago. But it's a purpose of items appear in the manufacturing process directly when you need them. Think of this Dell computer that I'm looking at. You know, Dell made this famous in the manufacturing and sale of computers. Reduces the cost of inventory, reduces the cost of securing and protecting that inventory, the storage of it, the accumulation of it. Items literally appear right when you need it. Managerial accounting is going to have a huge effect within this type. Now take that all the way forward and look at, you know, we opened again with taking a look at your receipt from the time that you leave the department store or the grocery store. You're reconciling that. Okay, what is that receipt telling internally to that retailer?
What was, cost of the goods.
The cost of the goods, it's also going to track inventory levels. Okay, it's going to let, okay, let's focus on Walmart. Items are removed from the shelf, they're scanned. It's going to track an inventory system here. It's going to alert someone when inventories are low. In today's economy, it's going to probably go ahead and trigger a buy order to replace that inventory. So we see managerial accounting has gotten pretty high tech here. And again, thanks to technology, that technology has fueled the global economy, the e-commerce, offering goods and services across the globe, value chain management, lean management. When I talk about lean, I want to talk about efficient. Think of a lean body, being more efficient. Okay, what's the chief purpose of an organization? I've not said this to you in a few weeks, so, but everyone that's taken my class walks out of here marching knowing this answer. What's the chief purpose of an organization?
Earn profit.
To earn. I'm here to earn, but let's strip the word earn out. Let's replace it with another word.
Maximize.
Yield.
To maximize profit. There we go. So when I talk about lean management, we are going, our chief purpose is to maximize profit. All right, so lean management, maximizing profit. If you will go through my presentation, you're going to see examples, more information elaborating with total quality management, which will be included under lean management. Just-in-time manufacturing, I've already given you an introduction to that. Value chain. All right, what are some ratios? And this is where we will be wrapping up. Seems like I wrap every discussion up with ratios. So log on in. We're still having fun.
No, it's, this computer always logged me out. It's like the cookies or something. It won't let me go ahead.
Yeah, mine will like,
It's a bug.
it's like if you stay on a page too long, like if I'm sitting here listening to you talk for like 5 minutes or something, and then I go to switch my page, it'll say enable
Right.
cookies, and I'm like, I don't even know what that means.
Right.
But
You asked
now,
my 4-year too.
now I want cookies.
Cookies.
That sounds delicious.
Cookies.
Sometimes.
Going to the store after this, and I
All right. What are some ratios that we're going to concern ourselves with? Let's focus on the manufacturer. What's step 1 in the manufacturing process? What do we must go out and buy?
Material, raw material.
Raw materials. Let's let that dry. All right, they must require raw materials. Once they acquire those raw materials, think of that as money going out the door. What's it important that we do? We want to replace that money that went out the door. In order to replace that money, we must turn over those raw materials, again, into work in process. We've got to push it down the chain. So you are going to have managerial accounting. We're going to say those decision makers are going to be looking at the raw materials inventory turnover ratio. How are we going to find this? TO turnover. No, that's what we're solving for. So we're going to find that by dividing the raw materials used by average materials turnover, or excuse me, average materials inventory. Raw materials used divided by average materials inventory. How quickly are we turning over these raw materials? When we talk about lean management, we're going to want to improve. If we see any room for improvement, this is where we would go to. Because in that first stage, when we're in the buying process, we've spent money. And if our chief purpose is to maximize profits, we just have an expense there. We have yet to realize any revenue. Sound good? Any thoughts? All right. That concludes my presentation.